Imagine waking up to find the savings of an entire nation frozen with the click of a button. That's what Russia learned in 2022, and ever since, central banks across the world have been preparing for the same fate. The Federal Reserve's latest cut is just one scene in a much bigger story. The dollar is being questioned, treasuries are being sold, and gold is being hoarded. Today, we're going to trace how a routine quarter-point cut is linked to a global monetary reset and why silver will be dragged along for the ride. Now, I should say I'm filming this while here in Ireland at the National Ploughing Championships, Europe's largest outdoor event with over 300,000 people attending. I'm here with the GoldCore team, speaking to farmers, families, and business owners all about gold. And let me tell you, compared to what we might have expected just a few years ago, it is remarkable how the mood has changed. Back then, you might have really had to persuade people even to stop and listen when you mentioned gold. But today, it's the total opposite. People are eager, almost insistent to know more because they sense that something in the financial system is not quite right, to put it lightly, and they want to understand how gold can help protect them. And that reaction from hardworking people who know the value of resilience, of safeguarding what you earn with effort, well, that connects directly to what we're about to talk about. Because if farmers at the Ploughing Championships here in Ireland see the need for gold, well, you can be pretty sure that central banks and global investors are seeing it too. And that takes us straight to the Fed's latest move and what it really means. Now, the headlines today will say that the Federal Reserve cut rates by a quarter point, and markets have pretty much already priced it in. Journalists, they'd already drafted their articles, and at the press conference, it produced very much kind of the usual catechisms about being data dependent. But the interesting part was not the cut, it was the dissent and the politics that were very much stitched into it. Brand new member Stephen Mirren voted for a deeper reduction at his very first meeting in the precise direction that the White House has been agitating for. First day dissents are unusual. They aren't accidents. They are signals, and the one transmitted here is that the consensus culture at the Fed is fraying at the edges, just as the institution is being pulled, not very subtly, into the electoral theatre. In the moment you pull the central bank onto the political stage, you dim the light of the dollar. Now, when the announcement came, Wall Street naturally celebrated and sulked in the same breath, and gold spiked, shuddered a bit, and then just looked like it might spike again. And silver caught a downdraft, as it often does when algorithms squared positions in the first minute after a Fed decision. The 10-year yield edged around a psychologically important handle, while the trade-weighted dollar gave the impression of a punch-drunk champion whose corner keeps whispering that everything is fine. Stocks, meanwhile, did their best impression of a child singing to itself in a dark corridor. None of this is surprising. When you cut into an economy with full employment on paper and softening underneath, the market here is not just easing, but something isn't quite right. Now, if this were merely a cyclical story, we could probably just all go home early. But there is a structural backdrop here that we obviously can't ignore. Foreign investors still adore Silicon Valley's early machine, but they increasingly refuse the currency wrapper that is coming in. Now, as the FT observed, the new fashion isn't sell America, it's hedge the dollar. Pension funds and asset managers across Europe and Asia have moved more of their US exposure into currency hedge vehicles at precisely the moment that the administration is making noises that a strong dollar is no longer wanted. The Fed is cutting, and central bank independence looks like a negotiable clause rather than a constitutional principle. Now, as hedging rises, the self-reinforcing bid for the dollar fades, and that is not catastrophic by itself. It is simply the opposite of the era we've lived through, when buying US risk automatically meant pretty much buying the greenback and thereby lifting it. Of course, the deeper alarm is fiscal, because for years we pretended that sovereign bonds were the cleanest shirts in the laundry. They still look crisp from perhaps across the room, but the fabric is wearing through. Governments borrowed aggressively into the pandemic and then discovered that the habit was pleasantly addictive. The result is steepening curves, persistent deficits, and a growing suspicion that the old idea of risk-free can no longer pass an auditor's test. And at the same time, large corporates have deleveraged, refinanced wisely, and sat on margins that are annoying for voters but consoling for creditors. It's a curious inversion. In more than one jurisdiction, top-tier corporate paper looks sounder than the sovereign standing behind it. And of course, against that backdrop, look at gold's behaviour. The textbooks all insist that gold loads high yields, but gold, being a stubborn pupil, has rallied against real yields, have risen and stayed elevated. Models that once mapped bullion neatly into inflation-protected treasuries have misfired, and correlations that felt like laws of nature, they've loosened their grip. This is not mysticism. It is monetary politics finally intruding into asset pricing. When a metal that pays no coupon begins to outperform the bond that does, you're observing not an error, but it's a verdict. Investors are asking which instrument over time is less likely to require your forgiveness. Now, of course, the verdict is broader than the Fed. On the day that Russian tanks entered Ukraine, the shock, that was geopolitical. 4 days later, when the US and its allies froze a G20 central bank's reserves, the shock was monetary. It declared to the world that reserves held in the wrong jurisdiction are not reserves. They are permissions, and permissions can be revoked. From that moment, central banks that had treated diversification as a kind of rhetorical garnish began treating it as policy. And the first moves, they were quiet. They were less chatter in dollars, more in euros, maybe a nibble at the renminbi. But over the next 2 years, a different pattern took hold. Sovereign treasuries in the developing world trimmed their US treasuries and added bullion. Not every headline was precise, and not every monthly edition was correctly reported or large, but the direction became unmistakable. You can tell a great deal about a system by what its smartest insiders hoard, and they hoarded gold. And of course, the logic didn't stop at the vault doors. There was a Russian proposal to denominate energy in grams of gold rather than dollars that was dismissed in Western capitals as theatre, but it wasn't. The idea was as old as money and very much as modern as the newest financial ideas we've got going on. Choose a unit outside of your adversary's legal reach and then set a conversion rate that works in your favor. If a producer decided to offer more barrels for the same gram, the implied gold price would rise without a single trader in New York clicking a mouse. Now, you might scoff, but you cannot ignore the direction of travel. The more that critical commodities are priced against an anchor, the less that the dollar is the sole lens through which value is seen. And in Asia, the quiet becomes loud. Chinese demand for physical has been relentless through this cycle. And the telltale isn't just retail bar sales or jewelry, it's the swelling inventories in exchange vaults, a kind of public scoreboard for stress. When traders prefer delivery over rolling paper, it means the optionality they prize is no longer financial, it is physical. And combine that with persistent additions to official sector holdings, and you see the outline of a policy. Ensure against sanctions, ensure against currency wars, and ensure against the temptation of your counterpart to change the rules mid-game. India has moved more cautiously, very often as we expect to see, but the direction is similar. Less enthusiasm for treasuries, more for bullion. Whether the precise tonnage is up by 30, 40 or 50 over a given year matters less than the revealed preference. What New Delhi and Beijing share is a recognition that in a world where the price of money is seized by politics, the price of gold is the politics. Now, there is also a cultural note worth acknowledging. In past cycles, gold was spoken of, perhaps with embarrassment, as tucked away in obscure charts and hedging strategies, but this time it is shamelessly mainstream. Wall Street banks talk about anything but the dollar, and reserve managers hedge their exposure. When the question shifts from why own gold to how much should you own, you are no longer at the fringe. You are entering a new orthodoxy. So where does this leave the saver or the allocator? I'm not going to give you a trading tip, but with perspective. The era of unquestioned dollar supremacy is fading, and a multipolar system is emerging in which gold's neutrality is a strength, not a flaw. Sovereign bonds are losing their halo, while tangible assets are gaining trust. And when gold moves, silver follows, more erratic, perhaps more theatrical, but driven by the same distrust of promises. Now, policymakers may yet stabilize the system, but even in a best case scenario, the lesson of the last few years is going to endure. Trust cannot be decreed. Until credibility is rebuilt, the world will keep voting with its balance sheets, moving steadily from paper claims to assets you can weigh. And that is why this bull market in gold and silver, it's not hysteria, but it's a referendum on governance. And if you want to find out more how you can take part on this referendum on governance, why not click on the link below and download one of our guides now.